Good morning. My name is Jonathan Levin. I'm a columnist with Bloomberg Opinion. We're here for Jobs Friday. We have Nick Colas. He is the co-founder of DataTrek Research, as well as my colleague Allison Schrager, Bloomberg Opinion columnist and author of An Economist Walks Into a Brothel and Other Unexpected Places to Understand Risk. We're here to talk about payrolls here. It's coming down the pike in about 5 minutes. The expectation, as I have up on my screen, is that non-farm payrolls are going to increase by 240,000, which would be a little bit cooler from last month's 303,000. If the street is right here, that would translate into unemployment staying steady at 3.8%. So, Nick, what's the news to look for here? What constitutes a good outcome in this first major data release for really the second quarter?
Yeah, the best possible outcome is going to be some slowing in labor market demand, which would mean maybe a few fewer jobs created than what the consensus might be. We also want to see wage growth really cool because that's an important part of how the Fed thinks about how the labor market interacts with the price market, with inflation. And we've seen still very hot wage growth over the past 6 months, over the past year, and particularly in the last couple of months, that has had the effect of keeping inflation higher than the Fed wants it to be. We'd also like to see participation rates rise a little bit, so as people are still coming into the labor market and cooling down the market because you've got more of a supply for labor. So the ideal is something that gets us to a slightly lower yield on 2 years, on 10 years, and gives the market some confidence that the Fed can actually lower interest rates over the course of the rest of the year. You know, we had Powell talking about this quite a bit at his press conference on Wednesday, saying he wasn't as confident as he was at the beginning of the year, that inflation was going to be coming down. And this report today is going to give us a lot of information about how quickly it can come down relative to the kind of disappointing inflation numbers that we've seen over the past 3 months.
Right, and of course, the backdrop here is that the back half of 2023 was pretty positive in Fed terms. You had a run of 6 or 7 very good inflation reports, which were also accompanied by evidence that the labor market was "quote unquote" getting into better balance, which meant a slightly slower clip of growth in those payrolls and less wage inflation pressure. The first quarter seems to have turned that around a little bit, and we're looking to see if that was a bump in the road or sort of a new trajectory here. Allison, Goldman Sachs' Spencer Hill says that immigration is going to continue to boost labor supply to the tune of about 50,000 workers per month this year. Is this the driving story of the labor market here for the next few months, the next year?
Um, I mean, perhaps. I mean, I think the driving story right now is just the demand for labor is still insatiable. And, you still have employers complaining about job shortages and that they can't find people. So, I mean, that sort of will certainly increase the appetite for immigration, but even immigrants don't seem to be enough to sort of meet the demand that people have for labor. And as long as that's true, wages are going to be high and unemployment is going to be low. And the idea of a rate cut just seems like, wishful thinking.
Sure. All right. So about 45 seconds here. Briefly, Nick, to you, what are the stakes here in markets? Right, yields are still pretty high. Does that mean that the risks are skewed towards a bond market rally with this print?
I mean, let's hope so. But I mean, the 2 years are so close to 5%. That's been kind of a trigger point for markets over the past 12 months. Whenever you see twos or tens get close to five, equities have really had a tough time. We saw that from July through October of last year. And obviously, we're going to see what happens with this report and see how close or how much over 5% 2 years can be today.
Sure. Okay. And we've got that number coming down the pike in just a second. Again, 240K is the expectation. And there you go. It comes in under 175 is your print for total non-farm payrolls. Private comes in a little bit softer than consensus as well at 167K versus the expected 193K. The unemployment rate ticks up a little bit to 3.9% from 3.8%. Some more news that the Fed can like. Average hourly earnings, month on month, seasonally adjusted, ticking up just 0.2% versus the previous 0.3%. And on a year basis, that ends up translating into a 3.9% move. I'll take you over very briefly to the price action on the 10-year Treasury note. We see yields stepping down in a meaningful way on the back of this print. So we were just around 4.54% on your 10-year going into the number, and we end up moving down, close to about 10 basis points off the bat, the knee-jerk reaction. And so, Nick, here we are. We were talking about this a little bit at the outset. The first quarter was perhaps warmer than the Fed would have liked across a series of metrics. We had been hoping that we could maybe turn the page in the second quarter. This is our first major data release of that second quarter. This has got to be good news, right?
This feels a lot better than what we had in Q1, that's for sure. As we were talking about before the numbers, slightly less job creation than expected, slightly less wage growth than expected. Those revisions, I think, were also going to catch people's eyes. Revisions of down 22,000 for the prior 2 months. So all in all, this is a pretty solid report and definitely is not as dire as what Powell was talking about on Wednesday. Powell usually gets a look at these numbers when he has a press conference the week of a jobs report. He said that last year. So he sounded like this was going to be a little bit more of a hot report. It's coming in a little bit cooler. Net, that's a big positive, I think.
Sure. So speaking of Powell, and Allison, I'd love to get your reaction to this. Powell has tried to walk a fine line on the relationship between labor markets and his job there at the Fed. He's kind of saying that the labor market and wage pressure or wage inflation are not necessarily a problem for them, but they might be under certain circumstances. And I took down what I thought was the key quote on this from Powell. I'd love to get your reaction. Powell said, I don't like to say that either growth or a strong labor market in and of itself would automatically create problems on inflation, because of course it didn't do that last year. Of course, he's referring to last year when we experienced disinflation through sort of the supply chain channels, and the labor market remained relatively strong. Powell continued, the point with wages is, of course, we, like everyone else, like to see high wages, but we also want to see them not eaten up by high inflation. And that's really what we're trying to do, is to cool the economy and work with what's happening on the supply side to bring the economy back to 2% inflation. Part of that will probably be having wage increases move down incrementally toward levels that are more sustainable. So is Powell striking the right balance there, or is he sounding like a policymaker who's trying to have his cake and eat it too, Allison?
Yeah, it's just like a nonsensical bunch of words. I'm just like not sure what he thinks drives inflation, if it's not the labor market or growth. Maybe he's trying to make more of a supply argument. I guess he is trying to have it both ways. There was this sort of curious movement, I guess, before the last bout of inflation, that the Fed should only care about the labor market and not worry so much about inflation, which I guess you could argue when inflation didn't seem like a problem. And, I guess that this is part of this movement to sort of disavow the Phillips curve. But, I don't think, you have a sort of, these odd periods where the Phillips curve flattens, and it doesn't mean that you've completely broken down the relationship between, economic growth and unemployment and inflation. I think we still can assume that inflation is still largely driven by high demand environment, and a high demand environment involves sort of, is it lower unemployment and high GDP growth.
Fair enough. Okay, I want to dig into these numbers a little bit here. So I'm going to put our decomposition up on the screen here, and please holler if this is totally unintelligible. But here's what I'm seeing on my screen. So we step down to a pace of 175,000 jobs in the month of April. That again is close to half the pace of a little north of half the pace of March. What changed here? Okay, so construction, which had been a big contributor in March, really cools meaningfully. So we go from construction, contributing about 40,000 jobs to American payrolls, down to 9. We have let's see what else sort of helped this number. I think this is interesting. Professional and business services, an area that you might say sort of heated back up in the first quarter. It's a diverse super sector, but it sort of represents a lot of white collar professions, including your lawyers and your accountants and your engineers. This was really rather hot to start the year. January, 48,000 jobs in professional and business services. And then it slows meaningfully in February and March. Payrolls actually contracted in that space in April. And same thing for information. I would point out. Information hadn't been as hot. This includes things like media, right? But again, payrolls actually contracting there in the month of April. But by and large, I don't know. Maybe one of you will disagree. I'm looking at this. It seems like a relatively broad-based cooling. It doesn't seem like it's driven by any idiosyncratic factors. It doesn't seem like one particular super sector is driving the move. As we look at the decomposition here, does this seem like a healthy development from March to April to you guys?
Yeah, it absolutely does. I'm also looking at leisure and hospitality, which seems to have come down as well. But I agree with you. The overall takeaway is you're seeing broad but modest weakness across a bunch of sectors. It's exactly what you want to see. You don't want to see one sector dominating all of this. And overall, that's a pretty healthy development. I'd also say, let's not forget that 170 is getting closer to that kind of 130 to 150 stall speed that we need to see because we do have population growth in this country. So zero job growth isn't really zero. It's anything south of about 130,000 to zero. So we're getting close to that number as well.
Yeah, and I gave folks a slightly different view. So this is rolling 3 months net change, so we can get a little bit of a better sense of the trajectory here. And again, it's precisely the narrative that we've been talking about. We had sort of from mid 2023 cooling, this pickup in January, February, and March that no matter what your narrative is, coincidentally or not, also coincided with a pickup in inflation. But here we are, April, the 3-month moving average is rolling over, and it's really kind of rolling over across the board, across categories. If there is one thing that over the past 3 months has continued to stay kind of warm, Nick or Allison, I don't know if you have any insights into this. Trade, transportation, and utilities, they're rolling 3 months job ads is still 137,000. That's that's up from the trajectory that they had been on. But everything else basically looks to me like healthy cooling. Nick, is this wage and labor dynamic conducive to more upside for the stock market?
I think it should be in the near term. Yes, the market has been so fretful over this issue and so worried about, what's the pace of inflation and do we get rate cuts this year? And you saw this big pullback in April, through the sort of middle of the month around that dynamic and rates going up. That the stock market really needs some reassurance that at least we have a shot at a rate cut this year, because while earnings are still going to be fine, I think by all measures, the real issue is you want to see a little bit of acknowledgement that rates are going to be coming down, not going up. And so this definitely helps with the dynamic. This should be equity friendly for today.
Okay. Allison, one of the arguments in the first quarter, some people sort of blamed the Fed for the pickup in inflation because they said that, well, Powell pivoted in December, and that loosened financial conditions, and that's why inflation sort of came back. I don't know that I personally buy that, but I'm interested in your take, especially in the context of here we finally got some good news, and yet yields are coming down. Are we stuck in this this sort of financial conditions doom cycle, whereby the good news causes financial conditions to loosen again, and then maybe we're back in the same thing 3 or 6 months from now? How are you reading that?
I think it's just hard to define good news, because I think good news is this sort of mythical or soft landing, which I guess I'm starting to think this is what the soft landing looks like. And, this jobs report is conducive to the idea that we're there and that, demand is cooling, but the job market's still really good. So that means that, maybe inflation will continue to go down, but like we still have a really healthy, vigorous labor market. So, I think, what we want to see is just so narrowly prescribed that, I think we're just trying to sort of give more to the Fed than they have. I'm starting to, as an economist, rethink how important expectations are. I think for a while we thought they were everything, and that, Powell's language in December sort of was already set in motion. This sort of, expansionary monetary policy, but I don't know. I mean, I don't think so anymore. I think it just, we still had strong demand, and I'm not sure what he said or what he did really sort of helped or hurt that. It is what it is.
Right. Okay. Fair enough. Okay. So let's see here. Where do we land here? You just dropped the words soft landing, Allison, and a big question is, everyone's talking about landings, right? When the Fed quote unquote normalizes interest rates, what is normal? Similarly, when the labor market gets back to steady state, what is that steady state? Because people used to say 100,000 is sort of the neutral pace of job gains. Now people are saying, well, it might actually be double that because of the immigration situation. But how long is the immigration situation going to continue at that pace? So what are your steady states, Allison?
I think we've landed. Like this is as good as it's gonna get. And I think we sort of, I think everyone sort of, their soft landing maybe in their head is when the Fed brings rates back down. But it seems like, the economy is trudging along with these rates, and or not trudging along, actually doing quite well. This is, I think, a really good jobs report. As I said, it's just labor market's good, but not too hot. I guess the last GDP report, some people had issues with, but I think it still pointed to sort of high demand in consumer goods. So, I mean, I think, you're not going to have it all, but I think this is about as good as it's going to get until something in the economy breaks, which could be completely exogenous anyway.
Fair enough. Nick, help me put this in the context of another Bureau of Labor Statistics data point, JOLT, which came out earlier in the month, or earlier in the week. I know you wrote about this. I mean, job openings to unemployed people is still fairly elevated, right? How do we square that with what we're seeing in the cooling payrolls today?
Yes, you're right. I mean, there's been a structural shortage of labor in this country since the late 2010s, called 2018, 2019, when those openings first went above the number of unemployed. And we had the big interruption of the pandemic crisis and all those issues that made the data very hard to read. But it's pretty clear that we're coming out of that into more normal times with still a structural shortage of labor, which means openings are still above. Now, they've been coming down, quite nicely. So it shows there's less labor market pressure than there was 2 years ago. That's great. But they're still structurally high. And the question is kind of where do they land? Where does that part of the soft landing look like? Where does labor demand land, so to speak? And on that count, it seems like we're still going to have structurally more demand for labor than supply when everything finally totally normalizes out in 1 to 2 more years. And that puts underlying pressure on wages, which are going to be kind of hard to foot with the Fed's goal of getting to 2% inflation. So the JOLTS data tells us, yes, the same thing that this data today tells us. Labor market's cooling, wage growth is going to cool. All those things are pointing in the right direction. But those structural issues of how much demand for labor versus how much supply were with us before 2020 and they're with us today.
Yeah, yeah. I wanted to put up one additional screen to sort of underscore how um, how to think about this labor market. People who would argue that the labor market needs to cool further, they kind of have to tell me where they would expect that cooling to come from. For instance, there are a number of idiosyncratic super sectors and sectors within these numbers where we just have sort of like a desperate economic and social need for people to fill these jobs right now. The one I always turn to is healthcare and social assistance, which is the one that I put up on the screen, which I think is not the best barometer of where you are in the economic cycle. And I definitely don't think the Fed should be in the business of slowing the onboarding of nurses, for instance, who are desperately needed in America's hospitals, right? So what you have here is a steady grind of like every 3 months, you're adding about 250,000 jobs to the payrolls of healthcare and social assistance firms in this country. And to me, that's setting a floor, at least in the near term, under what these numbers are going to look like for the foreseeable future. And I think that that's a good thing. Like if we're in a situation where we're stopping filling the shortage of nurses and doctors at our nation's hospitals, we've probably got bigger problems on our hands there. Are you with me, Nick?
Yeah, I definitely understand what you're saying, but I would also just say that as the economy slows, demand for most goods and services slows. They all, there's very few exceptions to that rule. And in addition, you can't hire a nurse until you have somebody go through nursing school, and that requires paying tuition. So there's
Yep.
also a dynamic of where do you get the supply from? And if people are feeling more financially stressed, maybe they don't complete their degrees as quickly, and you can't hire the incremental nurse or doctor because they don't exist. So there's some underlying economic realities of even the most essential parts of the labor market. That a combination of rates and economic growth are always going to affect. Everything kind of moves up and down together.
Okay. All right. Uh, how should we think about pricing power in the context of uh, this Fed journey that we're on? I ask because my ears perk up. It's earnings season right now. It's been a pretty good earnings season. I think all told, a little bit of a mixed bag, but my ears perk up on these conference calls every time folks talk about pricing power, and they are still mentioning it, right? I think if you chart the mentions over like the last 8 quarters, certainly they're coming down. But you listen to firms, in consumer discretionary areas, including restaurants, hotels, things like that, and they claim that they still have some pricing power with these consumers. Is that a reasonable place to land, or do CEOs need to feel like they can't push around the American consumer quite as much for this thing to be resolved?
I mean, usually what happens is you get a shock to demand at the end of a cycle, and demand goes away, and companies go from searching for the last dollar revenue to searching for how to cut costs and stay alive. And we're not yet at that second point. I'd say we've had a pretty good earnings season and a pretty lousy revenue season. Earnings have ended up being fine because of cost cutting, but revenues have been lighter than usual relative to expectations. So that
Hmm.
tells you that we're kind of reaching the end of the ability to push on price increases. And frankly, I think a lot of companies, Starbucks, McDonald's, for example, are focused on units as much as they are on prices. They're losing units because prices are too high, particularly in the mid to low end consumers. So I think at that level, companies are kind of moving beyond let's go get price to, hey, how do we get back some of that volume we're losing?
Okay.
Yeah, I mean, we're also seeing as well, particularly in these service jobs and food service jobs, a lot of their pricing is because of higher labor costs.
Yep.
So,
The California development, right? The big minimum wage change.
yeah, and if you look at the work of Chris Conlon at NYU, he's showing since 2020, I mean, wage costs have really been, the big driver of price increases. I mean, it depends what time period you look at, but
Yeah,
you know,
it's a super important point. Yes.
Okay. So is that sort of bearish for stocks going forward? I mean, that's one less lever that CEOs and CFOs can pull here. Um, I mean, basically, you have to be a bull on the real economy to think, and productivity to believe that the S&P 500 has upside here, at least in some of those consumer discretionary spaces.
You do, and consumer discretionary has not been a great group this year. So I think the market's beginning to realize that. But what's interesting is if you look at the earnings expectations for the S&P out for the next 4 quarters, analysts are looking for like $55 a share in Q1, the numbers that we're seeing right now. They're looking for close to $65 a share in Q4. So the market's expecting to see 20% odd earnings improvement over the next couple of quarters. I'm not sure how you get there. The street's usually high and the market knows that. So maybe this is not that big a deal.
Right.
But you are getting a lot of expectations for earnings improvements starting in Q2. Q2 is supposed to be another record for S&P earnings. And that's going to
Hmm.
require cost cutting. We're not going to get there from revenue growth. And what you're seeing in the numbers today is where micro meets macro. The macro has said job growth has to slow. The micro, which is companies' hiring policies, say, you know what? We have to be letting go of some people and hiring more selectively because our margins are getting squeezed right now. Volumes aren't there. Pricing's at the end of its rope, and our cost structure is too high. We hired too much in 21 and 22. We got to start cutting back in 24.
Okay. All right. Um, Nick, what is your do you do a target on like the 10-year bond yield? How would you describe this sort of unusual place that the U.S. 10-year Treasury note is in right now? It seemed like it was a bit of a perfect storm, through April, from geopolitics to inflation reports and everything in between. Uh, you know, I one thing I like to read and follow quite closely is the New York Fed's survey of primary dealers, and virtually nobody really thinks that the Fed funds rate is going to average something like 4.5% over the next 10 years. I know you got to throw a premium on there, but does this level make much sense to you?
No, it totally does. It absolutely does, because ultimately 10-year yields are a function of inflation expectations and real rates. Inflation expectations are running low twos, 2.3, 2.4, and real rates are running 2. Real rates should be 2. They were 2 before the financial crisis. They were 2 from 2003 to 2007, and that's a perfectly logical place for them to be. So when you decompose it along the lines of real and inflation expectations, you get a very sensible level, and I don't think we're going to move much off of 4, 4.5. Hopefully not to 5. But we're not going to move off these levels for many years now. And it's not a function of Fed policy. It's a function of being appropriately compensated for term premium and all those other things we love to talk about, and inflation expectations, all of which kind of adds up to 4.5%.
What do you think, Alice?
Yeah, I think that's largely right. I mean, I'm still subscribing to the view that markets are segmented in the bond market, and short-term yields are largely driven more by monetary policy, and long-term yields represent more sort of macro forces. I mean, I'm more pessimistic, or maybe optimistic, depending on how you look at it, that the 10-year might end up hovering around 5%, maybe not in the immediate future, but I think sort of in the medium to long term, just because of various macro forces around our debt and demographics and whatnot. But I said, unless we have a major return of QE, which is not something I would rule out, because the Fed does seem to love to do that. I do think the 10-year is going to sort of, as I said, is its own market.
Yeah, you mentioned QE, and I had to ask you about this, Allison. So one of the developments from the Fed on Wednesday, interestingly, of course, they held pat with rates at 5.25% to 5.5%, but the real action, you could say, was in the QT policy, where they lowered the cap on Treasury runoff, effectively, some people say tapering QT. Does that policy make sense to you, with the inflation genie still not back in the bottle?
No, and you're the first one who suggested this a couple months ago, and I did not believe you. I thought you were crazy, but you were right. You were totally right. And yeah, because they're just running off their bond portfolio now, so I assume that means that they're going to start buying, as I said, longer term treasuries, which does seem crazy, not only because the inflation genie's out of the bottle, but it really sort of means to me like permanent QE, and especially because the Treasury is issuing fewer medium to long term bonds. It doesn't seem like there's an excess of them in the market. So I said, this is the danger with doing huge QE like this, is it sort of just becomes sort of a permanent state of affairs, which as I said, could really change the dynamics of the bond market. But yeah, it didn't make sense to me, but what can you do? They do a lot of things.
Nick, the last time they tried to do a sort of tapering situation, they got themselves into trouble. They had an accident in the repo market, and it seems that that's the logic behind the tapering here.
It is, yeah.
Are theoretically slowing down to prevent the accident, and one could argue that might allow them to run this program for a little bit longer. Is it the right policy in your mind?
I think they have to at least try. I think Allison's right that it doesn't make a ton of sense, but they have to try, because ultimately this is a piece of Fed credibility on the line as well. They know that the balance sheet is huge. They need to keep bringing it down. They don't want to have an accident, so they'll go as slowly as they can, but they're going to try to tiptoe into their own kind of new reality and hope they don't break anything along the way. Because you're right, 2019 was kind of an unpleasant breakage after trying to reduce the balance sheet the last time around.
All right. Well, we're going to leave it right there. Your news from Jobs Friday here is that the unemployment rate ticks up to 3.9% versus an expected 3.8%. Non-farm payrolls in the United States of America increased by 175,000, but that ends up being lower than expectations. And in a world in which monetary policy seems to be dominating everything in these markets, that translates into some bullish price action on our 10-year U.S. Treasury note. Thank you very much to Allison Schrager, Nick Colas, and to everybody for joining us.